Ladies and gentlemen, and now to present our next award, the Tax Prof. Thank you, thank you. Yes, yes, thank you. Thank you, yeah, yes. Thank you, thank you. Yes, thank you. Woo, yeah, come on, get excited. Get excited for tax. Woohoo, yeah. Yes. Thank you, thank you. All right, all right. All right, so the next award is one of my favorite awards and videos, Top 50 Tax Cases. In this video, we're going to talk about the 50 most important tax cases out there historically. Hold on, let's jump into it. Very, very important stuff. Here's a list of the top 50 tax cases, and we're going to talk about each of these. We're going to summarize them. I'm going to tell you kind of like the key elements, and again, the central holdings and the more narrow holdings. But it's important to note that these cases are Supreme Court cases. They're top 50 tax cases. They're not the only top 50 cases out, or, you know, it depends on who you're talking to, but these are some of the cases you're likely to see over and over again mentioned in different opinions. So let's go ahead and start. And with each of these cases, it's important to note what of the 5 general questions of income tax, right? What amounts gross income? What amount deduction? What's the character? The when question, the timing question, and who? Each of these cases, for the most part, not all of them, but most of them, they focus on one of the 5. Now, they can have multiple questions, but again, there's a central focus. You're going to see some of the cases have more than one main question. Those are kind of the outliers. I'll show you a few of them, which for those cases, just kind of get the general idea of what the case deals with. But for any case that has a general one of the 5 questions, make sure you note that when you're going through the case and you're studying or getting, using in practice or whatever it is. Also, so consider the central holding of the case, right, and the general idea, any types of doctrines or any types of general rulings that come from the case. Consider which of the 5 questions. If you ever have a fact pattern where you're given a general fact pattern and I ask you, or you might see in practice, okay, which of these 50 cases is most applicable? That's important as well, so make sure you consider that. Also consider a lot of these cases are related to others. So if there's any relation to other types of cases, you want to make sure you maintain that. We'll see some examples, and I'll make note of that as well. So I'm really going through these cases. I'm really highlighting those elements. All right, so the first case we got is Arkansas Best. And remember that when you're looking at these cases, you can just kind of know them by the title because a lot of them have commissioner in them, U.S., and it's important to note that where the party's name stands, that's going to be the petitioner respondent to the Supreme Court. Again, these are all Supreme Court cases. Now, you can look at the procedural history to see, well, what happened to procedural history, but this is just saying at the Supreme Court level, the party on the left is going to be the petitioner, right? So they're the one that lost the appeals decision, and they're petitioning to the U.S. Supreme Court, and then the respondent, they actually won at the appeals level. That's why for most of these, you're going to see that the United States or commissioner is usually the respondent, because usually in most tax cases, not all, of course, most tax cases, the government wins, okay, just so you know. And the reason for that, as we've talked about before, is because the burden is almost always on the taxpayer to prove whatever it is, right? If you can't prove a burden, think about, I'm sure everyone in the room has probably seen these like true crime shows on TV where they talk about like criminal cases and whatnot. You have to prove beyond a reasonable doubt. Well, the idea is that if the prosecution can't prove beyond a reasonable doubt that, that the defendant has committed the crime, then it's not up to the defendant to show, hey, I didn't do this. It's just they didn't show. So a lot of times that's what happens when a defendant wins a criminal case, is just the prosecution just didn't have enough evidence or didn't show enough of beyond a reasonable doubt that it actually occurred. So similar idea here, not exactly the same because we're dealing with, these cases are all civil, right? So it's not the beyond a reasonable doubt standard, it's preponderance of the evidence, more than 50%, more likely than not. But the idea still stands where if the taxpayer cannot prove, the burden is not shifted, then automatically the court has to be in favor of the government. Everyone understand that? Okay. So the Arkansas Best case, this case is a character case. Characterization. That's one of the five questions. That's the main question it deals with. And the main thing is that Arkansas Best basically it limited the corn products case. So that's another case we're going to talk about, corn products. And corn products, this case, it focused on how the list of what's a capital asset, it held that integrally related to a trade or business could not be a capital asset. So in the capital asset list, there's trade or business assets that are some of the capital asset lists. Well, integrally related to a business also fits within that as well, okay? Not a capital asset. That's what the corn products doctrine it dealt with. Now, Arkansas Best basically limited that, and it was another Supreme Court case. It limited that holding to specific types of transactions. So that's really what you need to know about that case. All right, the next one. Let me shift to a smaller pencil so I can get some more space on here. So the next case is Aerosmith. Aerosmith versus Commissioner. So this is a huge case. This one also deals with character. It's also a character issue. Now, you all might remember Section 1245 recapture, ordinary recapture, right? And you're recapturing, or when you get depreciation deductions or amortization deductions, gives you ordinary benefits, ordinary character benefits. When you later sell the property, 1231 long-term capital gain, so potentially a lower rate. So the issue there, the policy behind 1245 is that you're trying to match the characterizations because ordinary of ordinary, capital of capital, same idea. So you don't get a benefit, an ordinary deduction, and then you get a tax benefit being taxed at a capital gains rate, which is generally historically a lower rate. Now, of course, we can't match the exact rates because rates change every few years, right? If you look at, history of the income tax, the ordinary income tax rate at one point was 96%. Is it that today? No. So rates change all the time. We're not going to be able to match the rates identical, but the idea is at least of characterization, you can try to match those up. So that idea of Section 1245 is actually even broader. It's actually found in the Aerosmith Doctrine, okay? The Aerosmith Doctrine, it deals with that. It basically is a matching idea where we have to match various types of character. Now, the Aerosmith Doctrine has even applied even more broad, even to things like credits, and I'm not going to explain how that issue, because whenever I talk about that, students always ask me, well, how exactly does that work? Because credits don't have character. No, it's more about matching. With a deduction, you're getting a percentage, right? Versus a credit is a dollar for dollar. You all know that. There's times when you have to recapture things like that based on dollar for dollar versus percentage. That's all I'm going to say about that, okay? But the idea of Aerosmith is, again, if you get certain types of treatment, you might have to recapture future events because you got the benefit of that. And the perfect example, think in your mind, is depreciation, amortization. And when you sell the asset later on, if it's 1231 to capital, you better believe if you have a gain, you're going to have to worry about recapturing it. So that's the general gist of Aerosmith. Okay? And there's other cases related to Aerosmith. We'll talk about them, North American Oil, US v. Lewis. But this is a huge case, Aerosmith. All right, the next one, Better Business Bureau of Washington, D.C. versus United States. This one, I wouldn't say there's a general of the 5 questions. I wouldn't say there's one. It's many questions, I would say. Many of the 5, many questions it addresses. But the main thing is that when you think about tax-exempt organizations, this case basically lays out the principle that organizations which are overly commercial are not entitled to Section 501c3 tax-exempt status. All you need to know from that case. Okay, number 4, Blair versus Commissioner. Okay, Blair versus Commissioner. So in Blair versus Commissioner, the who question. This addresses the who question of tax. Who is subject to taxation, who gets deduction, those kinds of issues. Now, one thing about the who question is it's almost exclusively addressed in case law. There's a whole line of Supreme Court cases. Lucas v. Earl, Helvering v. Horst are the 2 main ones, but Blair versus Commissioner is another Supreme Court case that deals with that. And the idea established from Lucas v. Earl and Helvering v. Horst, which we're going to talk about in a few minutes, is the fruit and the tree doctrine. So he or she or it that owns the tree is the one that gets taxed on both the tree and the fruit. So we're going to talk about Helvering v. Horst, and this is the best one to explain this topic. In Helvering v. Horst, what happened is the taxpayer at issue received some coupons from a coupon bond. I think it was a father or some family member transferred the coupons from the coupon bond to the son, whoever the family member was. The father, we'll just say it was a father-son relationship. Father kept the actual bond, so that's considered the tree. And then the son has the fruit, the interest that comes off of the bond. So the court ruled, basically what the taxpayers were trying to do was get the interest income under the son's income level because it was a lower tax rate. The court ruled that actually the father was subject because the father owned the tree. So that idea is a very central notion in terms of who gets taxed on income. So this case is kind of an exception to that in a way because it says that the assignment of income doctrine does not apply, so it does not. So that idea where the tree, okay, the tree is whoever owns the tree is the one subject to the tax, does not apply when somebody is gifted a portion of an income right if the donor only owns the income right and not the underlying property. So what we're saying is what happens if the son that received the fruit, the tree, I'm sorry, the fruit, the coupons, what happens if the son later gifts that fruit to another party? So basically there's two levels. You have the father that owns the tree, the son owned the fruit, and now it's being transferred to another owner. Well, in that case, we're not going to impute it back to the father, okay? We're just going to say, nope, it's not going to apply. The person now that owns the fruit, they're going to be subject to tax. That's the idea. So it's kind of an exception to the general rules of the fruit and tree doctrine. Okay, so you can think of it as an exception to the fruit and tree idea. Okay. So the next case is Burnett v. Logan. So this is known as the open transaction doctrine. And basically the open transaction doctrine, what it says, there's a lot of rules in tax. And this is my apologies, this is a timing question. This is a when question. When is somebody subject to tax? There are lots of times in tax where you're able to, or the rule is that you don't get to offset your basis. You have to do some type of maybe a pro rata approach. So two examples, installment sales and you might remember the rules from annuities. So the annuity, the idea is that for an annuity in tax, it's any payment where you receive a payment over more than one tax period. So let's say you would invest in some type of investment plan where you're going to put $100,000 into the investment plan over a certain number of years, and then after, let's say you retire, you're going to get, I don't know, $20,000 a year for the rest of your life. Well, you might remember this from when you learn about annuities. When you start collecting those $20,000 a year for the rest of your life, you get to exclude part of your basis every year through what we call an exclusion ratio. You take the amount you're expected to receive using mortality tables from the IRS, so $20,000 per year based on how long you're expected to live, right? Which every year keeps going up and up as we become more technologically advanced. So you just go to the mortality tables for that number. That gives you kind of like your gross proceeds expected to get over your life. You then take that, you take your basis over that number, and that percentage is going to be how much you get to exclude of each of the $20,000 payments. So let's just keep it simple. Let's say that you're expected to get, I don't know, $300,000 once you start getting those payments, okay? Well, your exclusion ratio would be the $100,000 basis that you invested in the investment over when you're putting in money to the annuity over the $300,000 expected to get. That's, of course, 1/3, 33.333%, repeating, right? You then multiply that when you receive each $20,000 payment, and then you'd be able to exclude 1/3 of the $20,000, and then the 2/3 portion would be included in income. Now, that option is different than, let's say you were able to exclude the first 5 payments, the first $20,000 paid in the first 5 years. So generally, in tax, you're not allowed to do that. You're not allowed to just exclude your first $100,000, until you use it all up. That'd be too good to be true. Okay, time value of money. You'd want to be able to record more income in the future rather than now. So the open transaction doctrine actually allows you to do that. It's very rare. It's kind of like the exception to the general rules. Okay? And again, the idea is that you're able to basically use your basis, or it's a similar idea. You're able to use your basis in that example until it's fully recovered in order. So it's basically in order. Okay? So that's why it's a when question, because it's when you get to use your basis, right? If it's open transaction, you get to use it all up front. And the times where this open transaction doctrine is reserved are when things are very, very, very vague. So the facts of this case were that there's a sale of stock in an iron mine for cash plus 60 cents per ton of ore mined by the buyer. So the issue is you don't know how much ore is going to be mined. It's a variable amount. So the idea is that as the seller gets more money in the future, they're able to offset their basis up until they eventually use it all up, and then everything after they've used it all up is all tax. And honestly, taxpayers almost always would prefer that situation rather than some pro rata approach where you get a portion each year, because you get to use it all up front, right? Time value of money, right? You want to defer income as long as possible, accelerate deductions as quickly as possible. So that's the idea behind the Burnett v. Logan decision. It's called the open transaction doctrine. All right, so Commissioner versus Clay Brown. This case, even though it involves tax-exempt organizations, this is really it can be viewed as a character it's character. It's a character question, my apologies. It's character. What is the characterization? So one thing about capital gains, capital losses, we all know that long-term capital gains, preferential rates. But to get a capital gain or capital loss, you need to have a sale or exchange of a capital asset. There's some exceptions to that, but that's the general rule, right? Sale or exchange of a capital asset. So the issue becomes, what exactly do we mean by sale or exchange? Well, this case dealt with sale. So risk shifting is not an essential element of sale. So we're trying to distinguish sale from like maybe keeping some rights, more of like a royalty or a lease. So risk shifting is not an essential element of a sale. That's what you need to know about Clay Brown decision. Okay, complete auto transit versus Brady. This is a multiple. This case has multiple questions involved. Basically, a state tax on the privilege of doing business in the state is not per se unconstitutional when it's applied to interstate commerce. That's really all you need to know about that case. Next case is Cook v. Tate. That's another multiple question. It involves multiple of the 5. So this case, very old one. One of these cases where they have the Commissioner of Internal Revenue as the name. The United States can impose a tax even when the person receiving the income and property from which he received it were not within the territorial limits of the United States. This is a essential case when you're looking at international taxation, being able to tax people in different jurisdictions. Okay, so that's Cook v. Tate. Okay, number 9, corn products. We mentioned this when we talked about Arkansas Best. So again, think about the capital asset list. This is a character question. Character. As I mentioned, we were talking about Commissioner versus Clay Brown. To get capital gain, capital loss, general rule, you need a sale or exchange of a capital asset. So this case deals with what is a capital asset. Under Code Section 1221, a capital asset is any asset other than what's listed in the tax law. So the idea is corn products essentially said that there's really 2 main holdings. The Section 1221 list of what's not a capital asset is illustrative rather than exclusive. So it's basically saying the list of items, while they can be relied on, they're not the only things. Or it can be viewed we can kind of interpret it. It's not just extremely bright line. So in this case, they had to set out that idea because what the courts did was they dealt with two of the items on the list, okay, of the capital asset, what's not a capital asset list, deal with trade or business property. Trade or business personal property, trade or business real property. Certain trade or business real personal property, and all trade or business real. The case basically said integrally related to the business. If an asset is integrally related, it might not be 100% related, but it might be integrally related. So think about assets that might have some relation to the trade or business, but not all relation. If it's integrally related to the trade or business, it's going to be viewed under those rules, under what's not a capital asset. So if it's integrally related to a business, any resulting gains were ordinary rather than capital. So it's going to be one of the items that's not a capital asset, not. And the case actually dealt with stock. It has, when you hold stock in another corporation, which almost always is going to be considered a capital asset because it's almost always held as an investment. Not many businesses deal with, unless they have inventory, right, of stock, right, like trading companies, right, brokers or dealers in securities, is stock going to be held as inventory, right, or a trade or business asset. However, if the stock maybe is a supplier or a customer, well, then you might have the ability to make certain decisions, and then it's viewed as a trade or business asset because it's integrally related to your business. So that's basically what the court deals with. 10, cottage savings. So cottage savings actually, while some people think it's a character case, it's actually a when case. When? When do we have gross income? When do we have deductions? Okay? But if you think it's a character case, it's, there's certain elements that come about that might be character. The idea here is to have a realized gain or loss, of property transactions, you must have a sale or other disposition. And that's found under Code Section 1001, the gateway to all property transactions. Right? Amount realized minus adjusted basis gives us realized and realized gain or loss, and then it's recognized unless the non-recognition rule applies. So the question is, what exactly do we mean by sale or other disposition? So sale is a conversion of property for cash. Other disposition means that you're exchanging property or trading property voluntarily, involuntarily, for property that's viewed differently in certain ways. So in this case, there was basically two mortgage companies, two lenders that swapped mortgages that were pretty much identical. However, and the IRS said no, and they wanted to take a loss. The IRS said no, this is not another disposition because you're pretty much just taking on the same thing. It was the exact same amount of mortgage. It was pretty much the exact same interest rates. It was same default percentage, all these different things that they focus on with mortgages. The court said no. The actual borrowers are all different. It's not the same borrowers. So yeah, there might be everything else on paper might be identical, but since there's different borrowers, we don't think that this is the same. So basically the point of this case is that other disposition, that language, is extremely broad. So you can have a sale or other disposition in very, very, very broad circumstances. So that's why when you always learn about property transactions, almost always you're told, hey, if you have a property transaction where it's going away, disposed somehow, this is almost never going to be an issue, okay? Because it's very, very rare to see this kind of issue. Okay, Commissioner versus Court Holding Company, the next one. So this is another assignment of income doctrine, and this one is kind of an exception, just like Blair. It's another exception to the general rule. Okay, so this is the who question. So with respect to court holding, transferee completion of a transaction negotiated and fully arranged by a transferor may be attributed to the transferor along with an imputed transfer of proceeds. Honestly, the main reason why I have this one here is because it's, again, an exception to the general rules of the assignment of income, which is the who question, right? So, again, because the who question is based on case law, I went ahead and I include this case, but that's all I really want to say about that case. Other than that, not really that essential. You might come across it when you deal with the who question in tax, but other than that, not that important. Crane case. So this one's huge. Crane and Tufts go together. Crane and Tufts. So this case deals with, it really deals with the when question, but it can also be viewed as an income question as well. Zoom in. So when and the income question, okay? So the Crane case, basically the issue, what it says is the amount realized in a taxable transaction includes relief of non-recourse debt. Relief of non-recourse debt, which the property is subject. So the idea in this case is somebody invested in a property and they have a loan, and it's a non-recourse loan. Property basically goes underwater. The liability becomes more than the value of the property. So then what happens is the party, they're going to dispose of the property, and for all intents and purposes, the facts, and you can read the facts, this one's an interesting fact pattern, pretty much the other side just takes on the property. Miss Crane, she really didn't get any money. There was some money, but it was very, very, very low amounts, okay, when you look at the whole scheme. So basically, the party taking on is taking on the liability, and they're taking on, they're getting the building with the liability on it, and they now are subject to they now have this liability. They're responsible for it, okay? So the question was, does she have to include in her gross income, in her amount realized, the amount of liability that was relieved? And the answer is yes. So the amount realized in a taxable transaction includes relief of non-recourse debt to which the property is subject. So the case, and there's a footnote, defer the resolution of whether the rule applied if the debt exceeded the fair market value of the property transferred. Okay? So in Crane, the property at one point was underwater, but it ultimately didn't go underwater. So that was a key essential element. So if somebody takes on your property, okay, and the fair market value is more than the liability, but they take on the property with the liability, then you include the liability relief in your amount realized, okay, in determining your realized gain or loss. That's the key. Tufts is going to answer what happens if the liability in the same situation is greater than the fair market value. That's what Tufts deals with, okay? And actually, if you look at the case, 1947, Tufts ends up happening a lot later. So it took a while for that issue to actually come up. Okay, so we'll see that when we get to Tufts. Okay, next, Deputy versus DuPont. So this is a big case, okay? And this case deals with deductions. Now, when it comes to trade or business expenses, to be a trade or business expense under Section 162, it has to be an ordinary, necessary expense during the taxable year in carrying on any trade or business, okay, of the taxpayer. So this case focused on ordinary. What does ordinary mean? An ordinary expense is one that is normal, usual, or customary. A transaction that gives rise to it must be of common or regular occurrence in the type of business involved. So you focus on industry and certain issues related to that specific, whatever fact pattern is going on. But it's an objective standard. So that's what the case dealt with. But the reason why this case is so important is because the key language from the case states that income is basically to be defined by be interpreted broadly, and deductions narrowly. And the court says that deductions are matters of legislative grace. meaning that basically they're meant to be interpreted narrowly. That's how the courts take that. Okay, so this case focused on ordinary. What does ordinary mean for the Section 162 requirements? Okay, which ordinary and necessary, by the way, are somewhat similar, but there's still case law that deals with both. Separate case law deals with both. But this focuses on what exactly ordinary means, and it also focuses on the key language you always see is that deductions are matters of legislative grace. Okay. So next is Doyle versus Mitchell Brothers, very old case. So the taxpayer is entitled to recover the taxpayer's invested capital tax-free before deriving gain from the property. So this basically, when you have, this is a when question. Whenever we have a perfect way to understand this, amount realized minus adjusted basis, right? When you have a property transaction, you're able to subtract away the adjusted basis. So what this is saying is that the taxpayer is entitled to recover the taxpayer's invested capital tax-free, i.e., adjusted basis, before deriving gain. So if we're calculating the gain, it's not just going to be the amount realized. We get to subtract away the adjusted basis in calculating the gain. Easy. Some of you you're thinking, well, that's obvious. Well, at one point it wasn't, right? 1918, when the tax law was new, people didn't understand that because this concept of taxation on income was a new idea. Ooh, the next case, Duberstein. Duberstein, of course, deals with income, the amount of gross income. So this specifically deals with gifts. So you all know that gifts are excluded from gross income. But the question is, what is a gift? So gifts, a gift for income tax purposes comes from detached, this is the key language, detached and disinterested generosity, okay, specifically out of things like love, affection, and like impulses, is actually what the court says. But detached and disinterested generosity. So we're saying there is no quid pro quo. No this for that. If you're getting something in return, even if it's past, present, or future, can't be a gift. Detached and disinterested generosity out of things like love, affection, and like impulses. Also, the opinion determined that we're going to focus on the intent of the donor. So the donor's intent is what controls when we focus on whether there's a gift. Okay, the dominant motive, if there's any compensation, again, detached and disinterested generosity, and we also focus on the donor's intent, not the donee. We focus on the donor. Do they expect to get anything in return? Eisner versus McCumber, this is an income. Yeah. Because it's a function of when you get your return of capital. Okay? I guess you could see it as an income question too. It could be viewed as an income question. But whenever you're dealing with basis, recovery of capital, at some point you're going to have to recover it. So what they're saying is when you're selling it off, you get that basis. So it's, okay, is that basis going to be allocated at some other point? So you're getting it at recovery. But you could view it as income as well. Okay? So the Eisner case is definitely an income case. So the Eisner case was the first attempt by the Supreme Court to define gross income. So first attempt to define gross income. So if you look at Code Section 61, gross income is defined as income from whatever source derived. Very broad, and it gives you some examples of what is gross income, but they're not the only ones. The income has been defined that way since 1913, very broadly. So the Eisner versus McCumber case basically was a stock dividend issue. That's what was at issue. Stock dividends do not result in gross income. And the case explained that income derives from capital or labor. Mere growth or increment of value in capital investment is not income. So what they're saying is that basically the similar idea to what we saw in Doyle versus Mitchell, that you get to basically subtract away your investment, that your investment is not going to be taxed. Similar concept. that gain does not result in that. Now, this is the first attempt at determining what gross income is. This is not the main one that we use. The main one we use is called Glenshaw-Glass. Now, that's not to say that Eisner versus McCumber was overruled. That's just to say that they're viewed together. But Glenshaw-Glass is the one that we usually refer to. Glenshaw-Glass is the more relevant case. But Eisner versus McCumber is still an essential element to the line of gross income. Halvering versus Eubank. Service income is taxed to the person who performs the services. What do you think this is going to be? Who? Exactly. So again, there's a line of cases that deals with who. Lucas v. Earl and Halvering v. Horst are the main ones. This is a who question. So service income is taxed to the person that performs the services. Now there's an older case in this called Lucas v. Earl that also establishes this, and it does it in a more overarching, but this one was a little bit, more particular fact pattern, but they're the same idea. This companion case to Halvering v. Horst, which applied the assignment of income doctrine to donative transfers of income from property. So the Eubank decision dealt with services. Horst, which we're going to look at in a few minutes, deals with property. So the idea is that what you're going to see is that when you have the who question, we break it up into property issues and service issues. Who's taxed on property and who's taxed on services? Yeah. That's a separate issue. Yeah, not relevant to this. This is more like, let's say you have a contract with a spouse or some party that all money that you make is going to be split equally. Well, people tried to do that because their spouse will be a lower tax bracket. Back when the tax rates were really high, 60, 70, 80% tax brackets. So what the courts have said is that if you were the one that made the money, you should be taxed on it. If you decide to assign to somebody else, that's your own right, but you're going to be taxed on because you made the money. That's for services. Yeah. So the payroll tax issue, there might be special rules for that issue because it's a payroll tax issue. Because they have their own line of law. Frank Lyon versus United States. So in Frank Lyon, in a genuine multi-party transaction with economic substance, the government should honor the contractual allocation of rights and duties effectuated by the parties, in particular the allocation of ownership versus lessee creditor status. So this involved a sale-leaseback. You all have heard about sale-leasebacks in accounting, right? They talk about those when you learn about leases, right? So sale-leaseback in which the taxpayer took title to a building under construction and simultaneously leased the building back to the bank seller for long-term use. The court held this was not a simple sham. Thus, the taxpayer could claim deductions such as interest or depreciation. So this obviously dealt with deductions, but this could also be a character issue. Because if you're ever dealing with sale versus lease, that gets into the issue of, remember, capital transactions. To get capital gain, capital loss, you need sale, can't have a lease, or sale or exchange, right? So this case actually dealt with deductions. So deduction is the question, right, of the 5 questions, but it also could be viewed as a character question in terms of its broad holding. Students' favorites, Glenshaw-Glass. So in Glenshaw-Glass, we had Eisner versus McCumber, right? Old case. Glenshaw-Glass continues that line. And it deals with, do we have income? So Glenshaw-Glass defines gross income. Basically, the key language is, gross income results from undeniable accessions to wealth, clearly realized, over which the taxpayers have complete dominion. So what it does is, to have gross income, you need 3 elements. You need accession to wealth. You need clearly realized, so you need realization, and you need dominion and control. okay? And the courts kind of talk about each of those things. Accession to wealth, the way we kind of see that today is you kind of look at the taxpayer's net worth if it goes up, right? So that's why loans are not considered, when you borrow money, aren't considered gross income. Yes, you have an asset, you have more cash, but your liabilities also go up by a corresponding amount. That's why your net worth hasn't gone up, it stays the same, not gross income. Realization. Realization is an administrative convenience aspect, because the idea, the best way to think about this is think about stock. If we did not have realization events to trigger income, we would have to record gain, economic gain, every time the value of our stock increased. So if you own a share of stock and it goes up every year, you'd have to record that increase and record tax on that increase. That's obviously a huge administrative burden, valuing, reporting, both on the taxpayer and the IRS. So that's what realization deals with, clearly realized, okay? Now, we call that aspect severance in the tax law. If you can sever the income from the original aspect of what created it, whether it's property or services, then you have severance. Services always result in severance. It's like the fruit of your labor, right? You perform services, you get fruit from that. Property, a little bit more tricky, because you got to worry about legal property rights and stuff like that. Like, have you given up the property rights and stuff like that? It's not just a simple, oh, you've given up all rights. It could be some of the rights, not all. Finally, dominion control. Dominion control is, do you have 100% unfettered access and use of that item you have? So if you find a Rolex in the parking lot, and being the moral citizen you are, you go and turn it into the campus police, and they say, okay, well, we're going to have to keep this for a certain period of time. If they keep it for 3 years, you don't have gross income until you actually have outright access to it. Because basically what they're saying is that we're going to keep this until someone claims it. If nobody claims it, it's yours. So you don't have gross income until you actually get it. So just because you find it, right, and you turn it in, the year you find it is not when you have the gross income. It's the year you have the access. You can do anything you want with it. Because when the police are holding it, if someone comes and collects it, it's rightfully their property, it's theirs. But police say if nobody collects it, it's yours after a certain period of time. So there is a potential to get gross income in the future. So those are the three aspects. Gregory versus Helvering. So this one, multiple. I'm sure in some of your other tax classes, you've talked about things like the business purpose doctrine, sham transaction doctrine, economic substance. Gregory versus Helving was one of the original cases that dealt with this. Basically, when taxpayers try to do things to avoid tax, there's stuff called economic substance, substance over form, all these different business purpose doctrine, sham transaction doctrine that the IRS has in their back pocket to try to use. So Gregory versus Helvering deals with that. Form controls over substance unless substance controls over form. So what this means, I know it sounds really backwards, right? What it's saying is that in the tax law, there's lots of provisions that say, hey, if you meet these criteria, you get the tax treatment. So if you're trying to plan around it, you meet the criteria and you got it. Boom. However, so that's meeting the form. But if you meet the form, if you meet the formalities, but in substance you're not meeting those, you don't got it. Right? If you're doing some transaction to avoid tax, and even though you meet the criteria met, then you could still, even though you meet the criteria, the IRS might still argue it's not going to be that treatment. Perfect example is when you allocate partnerships, allocations. So we have substantial economic effect. The economic effect, there's what we call safe harbor rules, which means if you meet the criteria, boom, you got it. However, there's something called substantiality, which is not necessarily as clear cut. And that's where we get into these business purpose, economic substance, these types of ideas, sham transaction. So if you're doing something just because you're trying to avoid tax and there's no economics behind it, IRS can use this. So what's saying is that we can use the form over substance doctrine. So form controls over substance, meaning you have to meet the criteria in the statute. If you don't, too bad. But if you do meet the formalities, you do meet the ideas, If you lack the substance, too bad. So what is it saying? Heads, taxpayer wins. Heads, IRS wins. Tails, IRS wins. Commissioner versus Grotzinger. This is a big case. So this is going to involve deduction. So as I mentioned earlier, section 162, trade or business expenses. You need ordinary, necessary expenses incurred in the taxable year in carrying on a trade or business. You got to have a trade or business. So what does trade or business mean? This is a huge issue in the tax law. Huge issue. Huge issue. All over the place. All these recent changes in the tax law, a lot of them involve whether it meets trade or business aspects. And almost all of those provisions, they cite back to section 162, trade or business case law. So there have been cases over the years, but the most recent, the most relied on case is what's called Grotzinger, the Grotzinger case. And basically it says, to be engaged in a trade or business, a taxpayer must meet two things. They must be involved in an activity with continuity and regularity. That's the first element. Also have to be profit seeking as well, for income or profit. Because you can have activities that aren't engaged in for profit that could be continuous or regular. So continuity and regularity, that's usually where the courts focus when they determine if something is a trade or business versus investment versus personal, right? They say, okay, well, how actively are you involved in this? What do you have going on? Do you have many, if you're renting out property, renting is a big topic where it's trade or business or not trade or business or investment. If you've got lots of different rentals, more likely you're going to be trade or business. But if you only have one, you can still get trade or business. It just depends on how actively you're involved in it and what exactly you're doing. Okay, Harrison versus Schaffner. Assignment of income doctrine. So the assignment of income doctrine, that is the who question. Or I should say, what exactly is going on with the who question. So the Harrison versus Schaffner case, assignment of income doctrine imposes tax on the assigner of partial income interest in a trust if the donation consists of income from some but not all years. That's really all you need to know. So again, I mentioned that Lucas v. Earl and Helvering v. Horst, those are the main who question cases. Then there's some exceptions that come from that. We saw Blair. We saw the holding company case. We see Harrison v. Schaffner. These are some exceptions to those rules. That's all you really need to know about Harrison v. Schaffner. It's the who case. It's in that line of cases. And the central holding, as we talked about, tax on the assigner of a partial income interest in a trust if the donation consists of income from some but not all years. So the assigner is the one, not the assignee. Higgins. So Higgins is all about deductions. The deduction question of the 5 questions. So at one time, you weren't able to take investment expenses, or they weren't as easy as they are today, I should say. There was trade or business and personal. So in Higgins, basically we have Mr. Higgins was managing and investing his investments. And he said it rose to the level of trade or business. And the courts disagreed with him. So let me just talk about the holding. Management of one's own investments in stocks and bonds does not constitute a trade or business. So if you're trying to determine if somebody rises to the level of trade or business, if you invest your own stocks or bonds, not going to rise to that level. That's what the case says, and that still is the case. Now, if you're a Goldman Sachs, Charles Schwab, these various companies that deal lots with like brokers and dealers and securities, that's their business, right? Different level. But we're talking about, let's say you manage your own investment portfolio, which a lot of people do. Not going to be trade or business, almost never. So it does not constitute trade or business. Hence, expenses incident to such management are not deductible as ordinary necessary business expenses. Key business. At the time of this case, that meant to hit Mr. Higgins, no deduction. So this is another thing. Sometimes the Supreme Court interprets Congress a certain way. What's Congress do? Congress then enacts Section 212 later. So this case came out in 1941. Section 212, which deals with investment type activities after Higgins. So it was a response to Higgins. So a few of the cases we're going to talk about, Congress responded to. It still is relevant law because it's saying, hey, this activity is not trade or business, which is still relevant for today. The problem, though, is that the conclusion of the case does not hold weight today because Section 212 now allows Mr. Higgins to take the deduction, but at the time it didn't because there was no Section 212. Yeah. Maybe, yeah. Depends on what level it rises to. Yeah, if you're dealing with someone else's. It could still be viewed as investment. But more likely to be trade or business if it's someone else's, yeah. But it depends on what level it's rising to. Yes. He was not able to take the deductions. Even under because they didn't have investment back then. It was just personal and business. Okay, so now we get to Helvering v. Horse. And we've kind of already talked about this case. So, again, this is a who question. Assignment of income. The who question, we break down into property. And we break down into services. So for this case, this is the main case, the central case for property. This is the one where we have a bond. And there's little coupons on the bottom of the bond. So the father, in the case, keeps the bond, but gives the coupons where you get to collect interest to the son. And the courts ruled he or she that holds the bond is subject, which is the father, is subject to the tax on everything. So if the father sells the bond later on, of course, that could result in capital gain, capital loss, but also the income collected goes to the father as well. Now, if you give up all your ownership in the bond, so if the father gave all the ownership to the son, it'd be a different story. But the fruit and the tree doctrine. The bond is the tree. He or she that bears the tree is subject to the tax on the fruit as well. So notice in here it talks about Helvering v. Eubank. We talked about that as well. It's one of the items that we mentioned. Okay. So again, this case involved interest coupons stripped from the underlying bond. By the way, there was a code section that later came out that addressed this, which you don't really need to worry about. It's a very specific thing, but the idea that's central to this is still relevant in today's practice. Right? Okay, next. Commissioner versus Idaho Power. So this one is both a deduction and a when question. But you're going to see that I have some slides later on that go through this as a deduction question, which is fine. What it says is depreciation expense and other material costs must be capitalized to the extent the underlying assets contributed to the cost of a long-term asset. Very similar idea we have in accounting. But as you all know, in accounting and tax aren't always the same. A lot of times they're not the same, right? Take municipal bond interest. Municipal bond interest always recorded as income for financial accounting purposes, but it might not be income for tax purposes. So accounting versus tax. We all know not always the same. Sometimes it might be the same, but not always. So this case kind of gets at, okay, depreciation expense and other material costs must be capitalized to the extent the underlying asset contributed to the cost of a long-term asset. So this results from section 263, which is where you capitalize and you depreciate under section 162, 167 depreciation, 162 for the expenses taken over time. And we'll look more at that case in a later discussion. Indianapolis Power and Light. This is one, okay. Sorry, I skipped one. Halvering versus independent life insurance. This one is quick. This is income. Do you all know about presumptive income? So, presumptive income, the idea of a presumptive income is economically, there's economic income, accounting income, and tax income. Of course, tax income is what we care about in tax. Economic income, of course, is the most broad, right? Of those three, economic income is the most broad. Now, our tax income takes elements of economic income, accounting income, and even other things into account. When you use your property or perform services for yourself, presumptive income comes into play. Think of it kind of like opportunity costs. If you paid somebody to mow your lawn, you would have paid them, let's say, $100. If you do it yourself, economically, you have $100 of income. That's presumptive income. Because it would have been $100 you would have had to pay somebody, and you're actually doing the work for your own benefit. You're actually performing it. It also applies to property. If you own a building or a house, and you would have had to rent the house for, I don't know, $2,000 a month, you have presumptive income of $2,000 a month living in your own house. The tax law does not include presumptive income. So presumptive income is not gross income. It's not even excluded. It's just not gross income. Okay? So in determining if something is gross income, we use Glenshaw Glass. We go through the three elements. I'm telling you that presumptive income is not in there. Why is presumptive income not in there? The main reason is it's administratively inconvenient for both the taxpayer and the IRS. Think about all the things that you would do that you could pay someone to do that you would have to take into account. Hey, right? I mowed my grass today. I have to record that as income on my tax return. Some countries in the past record this in their income. The UK, they used to record this. And they'd have a huge exemption amount each year. Okay. Commissioner versus Indianapolis Power and Light. So Indianapolis Power and Light is the case. This is one of my favorite cases. I have lots of favorite ones. Most of these top 50 are my favorite cases. This is an income question. Dominion and control. So remember we got Glenshaw Glass? GG. We got our three elements. Needed. You need to meet all three of those. What was the third? Dominion and control. Excellent. We've got a utility company, right? As the name suggests. Indianapolis Power and Light. What do all utility companies do? Deposits. Now, I'm not sure how much you all know about deposits, but sometimes deposits are refundable if you meet certain criteria. Other times they are non-refundable. If it's a non-refundable deposit and you receive it, gross income. The timing issue is obviously an issue. That's obviously a consideration, but this case focused on whether you even have gross income. Because if you receive money and it's a refundable deposit and the person meets the criteria, you are going to have gross income. So this case focused on the distinction between payments and deposits. Now, to have a refundable deposit that becomes money to you, the person obviously has to fail certain elements, right? Like when you let's say you're renting your apartment and you trash the place, you're not going to get your deposit back, right? Or pet deposits. Dog pees everywhere. Cat pees everywhere. Got to rip out the carpet and replace it. So, refundable deposits, it makes no sense for them to be included when they're received, right? Strings are attached. It's kind of like the Rolex example, right? That we talked about earlier when we talked about Glenshaw glass. It's possible you might get the Rolex, you might not. Pay the deposit, you might get the deposit, you might not. Right? If you get it, it's going to be gross income. But if you don't get it, not gross income. The question is, when you get it, timing, you should record it when it's actually been satisfied, not when you actually receive the money. So that is what Indianapolis Power and Light deals with. It deals with dominion and control when you focus on deposits. Now, I'll just tell you in this case, you can read about it if you want. Very interesting case. There were going to be some deposits that were kind of like in the middle. They might have been refundable, might not have. Yeah. Glenshaw glass. I call that one GG because we talk about it so much. Yeah. Yes, from the land. This is a good question. This is from the utility company or the landlord. Now, if you are in a business, you can get an expense, right? But that's going to be under a different line of law. This is for the income aspect of it. You can't apply that over to deduction. That's, again, why we focus on what the central holding, which of the 5 questions it deals with. Next one is INDOPCO. INDOPCO is a when question. Basically, INDOPCO says, similar to Idaho Power. By the way, do not confuse Idaho Power with Indianapolis Power and Light. Idaho Power is a deduction question. Indianapolis Power and Light is an income question. Indianapolis Power and Light, remember, is deposit. Idaho Power is when you have to capitalize an expense and you deduct. So keep that in mind. That's one that students always forget about or they confuse. INDOPCO is a when question. INDOPCO says that we're going to capitalize certain costs automatically based on what they are, and we're going to potentially recover them or not recover them. They just get recovered at the end. Okay? So an expense that creates a benefit in the future in a future year is a capital expenditure, even if no separate asset is created by the expenditure. The future benefit test. That's the key. So this case actually dealt with some expenses related or some costs, that a business spent, I believe, dealing with like organizational expenses that get capitalized in the organizational costs of the business, which if they're trapped as organizational expenditures, you're never going to be able to deduct them, right? You're going to recover them when you dispose of the business, right? When the business is liquidated or disposed of, that's it. So that's what the case dealt with. But it's even applied even more broad to hold even broader than that, just things in general. And we find that under Section 263 and even 263A, Uniform Capitalization Rules. Okay, next. Interstate transit lines versus commissioner. So an income tax deduction is a matter of legislative grace. So this is going to be another deduction question. It establishes, again, legislative grace, which is a huge principle. So related to DuPont, right? Deputy versus DuPont. The burden of clearly showing the right of a claim deduction is on the taxpayer. It's huge. So the burden for deductions in general is on the taxpayer. So the case actually involved an expense paid by a parent for a subsidiary business. The James case. This one's fun and quick. It's an income question. It basically says that illegal income is income. Illegal income, yes, you have to record it under the general rules. So drug dealers put on their tax returns sometimes other income, and they don't disclose what it is, miscellaneous. If it's really big, it might give suspicion, right? And there's been, issues of whether a tax return can be viewed as, evidence incriminating you on these types of things, and that's obviously a issue for a separate, law school talking about constitutional law and those types of things. Yeah. But this issue, I'm saying, what if you report your gross income? A lot of those people, like Al Capone, they didn't actually report it, and that's how they were able to say, hey, you have this huge luxury of life, these huge mansions, but you report such little income, right? And then they get them on the maximum penalty there. Kirby Lumber. So some of these cases, this is an income question. Some of these cases to you are like, oh, I already knew that. That's common sense. But you got to remember, this case is in 1931. These cases are old, and they, back then the tax law was new. Think of it like there's a lot of new tax laws that have come out recently. Getting that new tax law with not much guidance out there and not knowing what's going on. So this case deals with a discharge of indebtedness. And it says a discharge of indebtedness is gross income. So if you have discharge of indebtedness, gross income. And again, you're like, look, I already knew that. And this case came before GG, Glenshaw Glass. If you have Glenshaw Glass, this case is irrelevant, right? Because the first element is accession to wealth if your net worth goes up. If you have discharge of indebtedness, what's happening? Your assets are either staying the same or you're paying a little bit. Your liabilities are going down, right? If assets go, let's just say assets, let's say you didn't pay anything. Let's say a credit card was completely discharged. Assets stay the same. Liabilities go down, which means stockholders' equity has to go up, or owner's equity has to go up. Net worth goes up. You have less liabilities. So that's going to be gross income. So discharge of indebtedness, gross income quick. The next case. Oh, Glenshaw Glass was in the 1950s. So it was before. This court, yeah. So what I'm saying is that if we had Glenshaw Glass before this case, we wouldn't need Kirby Lumber. It'd be, there wouldn't be a Supreme Court case. It'd be established from the accession to wealth. The next case is another one of those cases that has multiple issues. Sham transactions are ignored for tax purposes. So remember I told you about business purpose, economic substance. Sham transactions, another one. Substance over form. Sham transactions are ignored for tax purposes. So if you're doing something for purely tax evasion purposes, they can be ignored by the IRS. Basically, some of you are wondering, well, aren't there a lot of things out there that, evade taxes? And you're right. One of the cases, Justice Learned Hand in a case basically said that a taxpayer is allowed to arrange his or her affairs in any way, even if it reduces taxes. That's allowed under the law. Okay, that's like the famous language you hear. But the caveat to that is that the IRS has these tools in their toolbox where they can come at you and say, hey, you did this purely for a sham transaction or economic substance just to avoid tax. The main area you see this is usually in business areas like corporate tax, partnership tax, because people will use these as conduits to avoid tax, where it's a lot clearer. Okay? So the next case involves sham transactions are ignored for tax purposes. P.G. Lake is a character question. P.G. Lake basically says that a taxpayer that carves out income component of property, mineral royalty rights. So if you have a contract and you sell that contract where someone's going to fulfill it, when you sell that contract, the seller has to record ordinary income or loss. Why? Because if you performed it, what would the character have been? Ordinary income or ordinary income, right? So think about it. A book of business. that an accountant has to continue to perform for clients, right? If there's contracts or ongoing work. If another accountant buys that, the accountant's selling for that asset, the character is going to be ordinary, even though it's considered intellectual property, which a lot of intellectual property gets 1231 or capital gain, like goodwill can get long-term capital gain self-created. It's going to be considered ordinary income. So for those of you who took me for previous classes, we spent time talking about the characterization of different pieces of intellectual property. One of them I talked about was contractual rights. That's because of P.G. Lake. So contractual rights, selling, the seller has ordinary income. Let's get through Lucas v. Earl. So United States versus Lewis. So in U.S. v. Lewis, tax consequences. So this one deals with when, the when question. The tax consequences in 1 year are not a function of treatment of the same or similar items in another year. So the idea is that there's a few cases that deal with this that basically say each tax year is kind of an independent determination. You can't view transactions together to be like, oh yeah, well, I'll go back and amend. We have the separate tax year type principle, okay? The close of the tax year principle, which North American Oil, which we're going to talk about, and Burnett v. Sanford and Brooks all deal with that issue, okay? So the idea is that if you have certain transactions, the close of the tax year principle, close of tax year, the general rule is that you can't go back and change those numbers. Now, there's some exceptions to that. There are some exceptions to the close of the tax year. We can go back in the past and amend. Okay? The main one being, you might remember, net operating losses in the past, you used to be able to carry back. You'd actually go back and amend previous tax returns. So that's an example of where you're able to go back and amend a close of a year. Okay? But we're saying, oh yeah, if you record a transaction and it later changes, you can't just go back and change that amount. Okay? You can't go back and just change that amount on a previous return. It's called the close of the tax year exception, or close of the tax year principle, but there are some exceptions to that. Finally, Lucas v. Earl, this is the big who question. So again, the who question, and we're going to take a look at this case next class. So the who question is broken into property and services. This is the main case for services. Income from services are taxed to the one who performs the services. So in this case, we're going to look more at the facts on it, but it was a husband and wife. What they basically did was they tried to split everything equally through a contract because the wife was in a lower bracket. Court said, no, husband, you can do that all you want contractually speaking, but you're still going to be subject to what you're taxed on. It was before they had a joint filing, but what if you filed separate? Actually, I think they did have joint filings. They filed separate. I think that was what the issue was. So that is the Lucas v. Earl decision. It mentions this case is distinguishable for Poe v. Seaborn. Poe v. Seaborn, by the way, I want to mention, is community property. So some of you are wondering, what about community property? In community property jurisdictions, everything is, for husband and wife, is 50-50, regardless who makes. So for community property, that's an exception. So in community property states, those are exceptions. You do get 50-50. Okay? You do get 50-50. So again, the general rule is he or she that performs the service is the one taxed on it. So if wife makes $200,000, husband makes $50,000, rather than join them together $250 and split it $125 right down the middle, right? Wife gets $200, husband gets $50. If you're doing married filing separate, if you're married filing joint, of course, it's both going to be on there. But if it's community property, filing separate, $125. So we're talking about Mallet versus Riddle. And in this case, the word primarily means of first importance in relation to common code phrase property held primarily for sale to customers in the ordinary course of trade or business. So this is going to be a character case, because remember, when you're determining whether something is capital, you have to look at that capital asset list, and we focus a lot of times on whether something is inventory, whether it's business assets, or whatnot. So the phrase property held primarily for sale to customers in the ordinary course of trade or business, that would get at inventory. Okay. The next case deals, or U.S. versus Midland Ross. This is a characterization case. So original issue discount. I've mentioned this before. Original issue discount, best way to think about it is think of like a junk bond. You buy a bond or invest in a bond real cheap, and maybe after 20 years, 30 years, you expect to get, maybe you buy it for $100, you expect to get $1,000 in 30 years. And the idea is that there's a very high level of risk that you're actually going to collect $1,000. So that's why they're referred to as junk bonds, because usually they're, you have the priority list of bonds, A, B, C class bonds. Junk is all the way at the bottom of the worst in terms of the least likely to actually recover your amounts. So the idea is that if you're buying a bond for $100 today, expecting it $1,000 in, let's say, 30 years, over those 30 years, there's implicit interest. You've all learned about the effective interest amortization method, all that stuff. The same thing in tax. So as you go over the 30 years, original issue discount is basically deemed interest that has to be recorded. So it's not as simple as just, okay, you get to record that rather than when you dispose of the bond, you get $1,000 minus your basis of 100, 900, right, gain. It's going to be recorded over time. So it's in the characterization provisions, and I put down its character. It's also a timing question. When? It's actually, I would say the main one is timing. Characterization is also an aspect of it as well, because when you sell your bond, what's the character of the bond going to be? Usually, if it's an investment, right, capital is capital asset. But interest is considered ordinary. So it's both character and timing. Timing being, okay, you're going to have to record interest over the next 30 years rather than just at the end of the 30 years when you have the sale for the gain, right, the $900, you're going to record that interest over time and your basis goes up every time you have interest. So that's really original issue discount. U.S. versus Midland Ross, market discount on financial assets has the flavor of interest. So that's the reason why I say specifically this is a character issue, this case, but it's also a timing because as a result, it must be characterized as ordinary income when included. This case treated original issue discount, which original issue discount is mostly a when timing or when issue, but there also is characterization aspects as well. So if I asked you about this question on an exam, or if you knew if this was an issue in practice, it'd be both a when and a character question. The next case is Moline Properties versus Commissioner. A corporation will be recognized as long as its purpose is the equivalent of business activity or it actively conducts business. So this question involves multiple issues. You might have heard about this case in your corporate tax class when you talk about business purpose, business doctrine. This is actually the case that they usually refer to as Moline Properties. Again, a corporation will be recognized as long as its purpose is the equivalent of business activity or actively conducts business. The next case, National Carbide Corporation versus Commissioner. This is an agency case. That's another one of these multiple issues. The Moline case and National Carbide go together as some of the most important cases dealing with corporate tax, whether you actually have corporate tax issues. Whether a corporation is an agent depends on many factors. So recently we were talking about factors tests. Here's a factors test, whether a corporation is an agent on many factors. The National Carbide provides a list of factors. North American Oil Consolidated versus Burnett. This is a huge case. This is the claim of right doctrine. This is the timing. When? There are two important holdings, but the main one is the claim of right. When a taxpayer receives funds of a contingent obligation to repay, either because the sum is disputed or mistakenly paid, and no limitation on the use of funds exists, those funds are included in the taxpayer's income in the year they are received. If they have to be paid back in the future, you get a deduction. That's known as the claim of right doctrine. So the idea is that, let's say that you receive a bonus from your accounting firm. This actually happened to me. I received a bonus at my accounting firm that was a function of me passing the CPA exam, but I had to stay at the accounting firm for a year. But guess what? I left before then. Went to law school. But I used the money however I deemed fit. When I received the bonus, guess what? It was included in income. The next year, I was able to deduct the amount because I included income, and I shouldn't have to because I never actually had to pay it back. Okay, so the same thing happens in practice with any issue. If you have to include something in your income under the general principles, and again, you meet the Glenshaw-Glass definitions for income, right? Accession of wealth, realization, dominion, control. So there's no like, oh yeah, we're going to put this in a fund and you wait a year, and then after a year, you can use the money. No, that's not what's going on. They give you the money, you get a check when you pass the CPA exam. If you don't stay at the firm for a year, you got to pay it back. So if it happens at the end of 1 year, which happened to me, and then the next year I left, it was obviously recorded on my income tax return for the year I received it. And then when I had to pay it back, it was deducted. Now, you're wondering, did I actually take a deduction on my own tax return? No. You know what they did? They just subtracted out my net pay for one of my paychecks, and then I just didn't have to record the income that year. That's what they did. So they actually adjusted it for me. But it's the same idea. So if you receive money, you're a business, and you receive money from a customer, and you're able to spend it now because you need it for inventory and stuff, but there are certain conditions that have to be met, and you fail them and you have to pay it back in the future, you get a deduction if it's between different tax years. Okay? The second element is that tax consequences in 1 year are not a function of the treatment of similar items in another year. And there's exceptions that come up with Burnett v. Sanford and Brooks and U.S. v. Lewis, which we talked about that one already. Let's go on to Old Colony Trust versus Commissioner. So this is another interesting case. Basically, look at the age of this case, 1929. This case actually deals with the question of income, whether there's income. Here's what happened. You got to remember, tax law, current income tax, 1913. Business was trying to get around their employees having to record income. So what they did was, rather than pay you a $100,000 salary, we're going to pay you a $70,000 salary and then pay your taxes on the $70,000 salary. Because if you pay if we pay you $100,000 all included in income, you're subject to, I don't know, let's just make it simple, a 30% effective tax rate. To pay $30,000 in taxes, you get paid what? $70,000. So they're going to say, we're going to pay you $70,000, and that's what you're going to record as income, and then we're going to pay your taxes on the side for you. Well, again, back when the tax law was not well known, people thought, hey, okay, then the employer has to record $70,000 in income, and that's it. No. This case basically said that the form of the income can take many different forms. So if somebody is paying an obligation that you normally owe, which here you normally have to pay your taxes, that can also be viewed as income. So the $70,000 was income and the payment of taxes was income. Poe v. Seaborn is a who question. Not who done it, but who is subject to income or deductions, right? This is along the lines of Lucas v. Earl, Eubank, Helvering v. Horst. We've talked about other ones, Blair. This one's pretty simple. It's the community property. The assignment of income doctrine does not override community property laws. So in some states, we have community property. Remember Lucas v. Earl? I told you what happened there is you got a husband and wife. They had a contract where the husband and wife, filing separately, split everything, even though the husband made almost all the money, if not all the money. So 50-50. Court ruled, well, he or she that makes the money is the one subject to the tax law on it, even if you designate it to go to somebody else. Community property, though, is kind of an exception to it, and it says, however, in community property, where everything is split 50-50 between spouses, it is 50-50. So the idea is that if Lucas v. Earl was in a community property jurisdiction, it would be allowed. That's all you need to know. Burnett versus Sanford and Brooks. So again, going along with the North American Oil and Lewis and the whole idea of you got the claim of right doctrine in North American Oil, and also North American Oil, the second proposition was basically, again, this close of the tax year principle where, hey, everything is an independent tax year. Going along with that, so this is a timing, a when. We have Sanford and Brooks. Tax consequences in 1 year are not a function of the treatment of similar items in another year. There are some exceptions that have arisen, but that's the main general principle. The main principle. Okay, Schluty. Schluty is another when question. You all are experts at cash method versus accrual method from an accounting standpoint. That's exactly what the Schluty case deals with. It's a Supreme Court case. It's very rare to see Supreme Court cases that focus on cash versus accrual method issues. But this one does. In Schluty, accrual method taxpayers that receive prepaid amounts for services must include them in income upon receipt. So if an accrual method taxpayer receives prepayments of income, guess what? Have to record them. This is now found in the tax law already in the code. And remember, there's times where code sections later created that. But that is a principle that if it's not found in the tax law, Schluty applies to. So again, accrual method taxpayers, normally when accrual method taxpayers in accounting receive prepayments, they record it as they earn the income. However, here, when you have prepayments, they have to record it in the year of receipt. So they're effectively putting the cash method for receipt of prepayments of income. Skelly Oil. So this is a timing question and a character question, because it relies both on Aerosmith, which remember was a character question, but it also relies on Sanford Brooks and North American Oil, which was a timing question, a when question. A deduction for repayment of an amount not fully taxed in the prior year may be limited to the portion taxed. So relying on Aerosmith doctrine, the court asserted this new rule does no harm to the Sanford and Brooks North American Oil formula that keeps each year independent of others. The court also analogized its new rule, the tax benefit rule, which operates in the reverse of Skelly Oil. In a critical limitation, the court limited the Skelly Oil rule with the following explanation. In other situations, when taxes on a receipt do not equal the tax benefits of repayment, either the taxpayer or the government may, depending on the circumstances, be the beneficiary. Here the taxpayer always wins and the government always loses. Hence, Skelly Oil rule applies in those limited scenarios in which taxpayer always benefits. So what it's saying is that this is a taxpayer-friendly rule. A deduction for repayment on an amount not fully taxed in the prior year may be limited in terms of what you can actually record. Okay? So you kind of have to see in the previous year if you recorded income versus getting a deduction in the future. So that's a tax benefit rule. This is the opposite of that. If you weren't able to get a tax benefit deduction in a previous year, you might have to record the income from that. So we've talked about Section 265, Section 111, where you get a tax. If you get a tax benefit one year, you can't get a tax benefit in the future. This is the reverse of that. This is the reverse of the tax benefit rule. Tax benefit rule is no double tax benefit, right? You get benefit one year, no benefit a second year. So this is, I guess it's mainly a timing question, I would say, but it also involves character as well. Because again, you have to focus on the character of what benefit you got. All right. Commissioner versus Sullivan. Rent and salaries are ordinary necessary expenses for illegal gambling businesses. So this is going to be a deduction question. Next, tank truck rentals versus Commissioner. Fines for overweight trucks are not ordinary necessary expenses. And there's already some code sections in Section 162 that deal with fines and penalties. Again, this is a precursor to that. So this is also a deduction question. 48. Thor power tool versus Commissioner. So this is going to be a when question. The Commissioner has broad discretion in determining what constitutes clear reflection of income. GAAP does not control. So what's saying is that a lot of times in the tax law, they refer to generally accepted accounting principles. For example, if you look in Section 451B, they actually rely on audited financial statements, and they talk about audited financial statements in accordance with GAAP. But what they're saying is that for many provisions that focus on GAAP, which you're going to find in the timing section, the when, IRS can deviate from GAAP. The Treasury can deviate from GAAP if they have the ability by Congress. They can do so. They go through the different methods, reporting inventory, writing down inventory. That's really what the case dealt with. No sale or salvage value, those kinds of things. Tufts. So Tufts goes along with Crane. So if you go back to Crane, remember the issue in Crane. You have a property that has a liability on it, and the taxpayer comes and takes over the property subject to the liability, and virtually the taxpayer got no other compensation for the property, just takes over the property because maybe the property has gone underwater. So there was a famous footnote in Crane that said, what happens if the liability was recourse? Because nobody would know. That would be, okay, would that create a different story? And remember what we found out in Crane is that you have to include an amount in your amount realized related to the transaction. So the question is, what happens if it's non-recourse? So Tufts answered that question. The amount realized in a taxable disposition includes debt relief. So the Crane rule applies even if we have non-recourse debt exceeds the fair market value. So basically what this case and Crane do together effectively in a very broad, or sorry, very basic level, it's not as basic as this, it's actually a little bit more involved, is if you have a piece of property, let's say the liability on it is $200,000 and the property is worth $108,000, and somebody comes and they take the property subject to the liability and they don't pay you anything, right? So effectively, you owe this $200,000 liability, you no longer owe the money. The value of the property is $180,000. So the question is, in your amount realized, what do you include? You include the value of the liability, whether it's recourse or non-recourse. Because you would use $200,000, not $180,000. You would use the liability when the liability exceeds the fair market value. That's what Crane and Tufts says. Crane focused on recourse, Tufts focuses on non-recourse. Boom. So what does that deal with? That deals with whether you have income or deductions, right, for losses is the main aspect of the case. Calculating the gain or loss is really what it is. Finally, Welch versus Helvering, very famous case. This is a deduction question. So remember, for Section 162, trade or business expenses, which at one time we only had trade or business expenses and then personal expenses. There was no investment. So to have a trade or business expense, has to be ordinary, necessary expense, paid or incurred in carrying on during a taxable year any trade or business. So the questions of ordinary, necessary, in a famous case by Justice Cardozo, ordinary and necessary are not easily defined. Justice Cardozo's poetic language is famous. Here, indeed, as so often in other branches of the law, the decisive distinctions are those of degree and not of kind. One struggles in vain for any verbal formula that will supply a ready touchstone. The standard set up by statute is not a rule of law. It's rather a way of life. Life in all of its fullness must supply the answer to the riddle. So basically what Justice Cardozo is saying is that there's a subjective aspect to a lot of aspects of tax, and ordinary and necessary has that. However, the courts have ruled that ordinary and necessary, the tests, are supposed to be objective, not subjective. So it just shows you how tricky the law can be. That in one case it says, hey, these elements are subjective, not objective, but then they say the standard should be an objective, not a subjective standard, what a reasonable person would do. And that concludes the top 50 cases.